Hi, let's discuss the elements of title insurance as protection of title. Title companies. A title company ensures that the title to a piece of real estate is transferable and guarantees the marketability of the title by issuing optional title insurance for that property. The title company reviews previous ownership records, examining the chain of title in an abstract of title. The conclusion from the review is summarized in a title opinion. Title companies also often maintain escrow accounts. These contain the funds needed to close on the home to ensure that this money is used only for settlement and closing costs. Title companies may also conduct the formal closing on the real estate transaction. At the closing, a settlement agent from the title company will bring all the necessary documentation, explain it to the parties, collect closing costs, and distribute monies. Finally, the title company will ensure that the new titles, deeds, and other documents are filed with the appropriate entities. Title opinion. A title opinion is the written opinion of an attorney based on the attorney's title search into a property, describing the current ownership rights in the property, as well as the actions that must be taken, if any, to make the stated ownership rights marketable or to clear any clouds on the title. Title opinion is not a guarantee of marketability. Title insurance. An opinion of title does not guarantee that ownership is free and clear. Issues may remain hidden, called defects of title. Title insurance may be purchased as protection against title defects. To protect the parties against these problems, title insurance companies offer title insurance. With title insurance, if any claim is brought against the property as a result of a pre-existing problem with the title insurance will likely cover the expense. Title insurance is not required by law. However, because of the risk involved with an unmarketable title, title insurance may be required as part of the closing when a mortgage is involved. Once the title search has shown the title to be valid, the title company will likely be willing to issue a title insurance policy. The policy protects owners or lenders against claims made against them and covers legal fees that may arise from disputes over the ownership of the property. There are two main types of title insurance: owner's title insurance, which protects the property owner from title issues, and lender's title insurance, which protects the mortgage company. Owner's title policy. An owner's title policy may be issued to cover the sales price of the property. It protects the new owner and the heirs of the new owner in the event that a defect of title surfaces. Defects can cause property owners to lose ownership rights. An owner's title policy is not transferable to a new owner should the property be sold. The cost of the owner's policy is charged as a one-time premium at closing. An owner's policy is issued for the price of the house, whereas the lender's policy is issued for the price of the mortgage that the policy is protecting. How much the lender's policy will cover goes down as the mortgage is paid, because it's actually protecting the unpaid balance. Owner's title policy summarized. Owner's title policy is issued for the sale price, protects the new owner and the buyer and or his or her heirs. It is not transferable to another party upon a sale, and there is a one-time premium that is charged at closing. Lender's title policy. A lender's title policy is issued for the amount of the mortgage. It is designed to protect the lender, not the borrower. If the lender sells the mortgage, the policy is transferred to the new holder of the mortgage. The cost of the lender's policy is charged as a one-time premium at closing. Lenders generally require that a lender's title policy be purchased. Lender's title policy summarized. A lender's title policy is issued for the amount of the unpaid mortgage balance at the start of the policy. Protects the lender against title defects. It does not protect the owner. It is transferable and assignable to someone else, another company buying the loan from the original lender. It protects the lender up to the outstanding loan balance. There is a one-time premium charged and paid at closing, and most lenders will require it as a condition of making the loan. This graphic is a nice side-by-side visual showing the comparison between an owner's policy and the lender's policy. As you can see, the owner's policy is issued for the price of the house or the sale price, whereas the lender's policy is issued for the mortgage amount. The owner's policy protects the new owner, i.e. the buyer, and the buyer's heirs, but the lender's policy is actually only protecting the lender. An owner's policy is not transferable once the property is sold to the new owner. However, the lender's policy is transferable to another company buying the original mortgage. And both policies are charged as a one-time premium at closing. Understanding the difference in policies. As a real estate licensee, be sure to understand the subtle differences between an owner's policy and a lender's policy. An owner's policy is issued for the price of the house, whereas the lender's policy is issued for the price of the mortgage that the policy is protecting. How much the lender's policy will cover goes down as the mortgage is paid because it's actually protecting the unpaid balance. And an owner's policy is in place to protect the new owners, whereas the lender's policy is put into place to protect the lender. So with the owner's policy, if the owner dies and the property is passed on to the heir, the protection of the policy does remain in place. However, the owner's policy does not pass to a new owner upon the sale of that property. Whereas with the lender's policy, the policy does pass, i.e. transferred, to the new owner of the mortgage. Mortgages are actually collateral that can be sold from investor to investor. And all investors that are buying the mortgage are will be protected by that lender's policy. And both the owner's policy and the lender's policy are paid as a one-time fee at closing.